From New York City, for our viewers worldwide, I'm Sonali Basak in for Katie Greifeld, and Bloomberg Real Yield starts right now. Coming up, countdown to the Fed, days away from the next U.S. central bank decision. And in the walk-up, short-end yields are on the rise, whipsawing throughout the week. And a flurry of issuance, underwriters looking to get ahead of the big rate decision. But we begin with all the big issues, all eyes on peak rates.
The September meeting.
The outcome of the September meeting.
I think the Fed will do what we all expect it to do.
Less hawkish policy.
Pause and, basically indicate they're data dependent.
The Fed has to, we think they're done hiking. They have to maintain this policy stance.
I don't think the Fed's going to be hiking much more.
I think they'll be inclined to deliver a hawkish pause.
We think they're done.
They have gotten good news on inflation.
The trend of inflation is actually moving slower.
Core inflation is moving in the direction they want.
The deflation story in core goods will continue to be there.
Most central banks are, I think, probably done hiking now.
When push comes to shove, I think the Fed's going to be very responsive to the labor backdrop.
I think we may very well be at the end of rate hikes.
Now joining us now are PIMCO's Jerome Schneider and Maureen O'Connor of Wells Fargo. Jerome, as someone who manages so actively along the curve, I want to ask you about the whipsawing of rates this week, because we have had a 13 basis point move intraday from the top to the bottom. We are off those highs, but we are pretty close to them. How drastically are expectations changing moving into the end of the year?
Yeah, I think that for the most part, there's a couple of factors that play into the volatility we're seeing. Number one, we're still coming off the summer doldrums where people are trying to digest risk. We've had a tremendous amount of corporate issuance come into the market over the past week, which has to be digested, some hedging effects to that. But we're also dealing with the recalibration of expectations, not only of inflation, but also where the Fed's destination of a terminal rate might be. And that, frankly, means that the market is more data sensitive than probably the Federal Reserve at this point in time in terms of digesting this. One of the interesting things, quite honestly, is the fact that the market has been, more or less sanguine about, the baseline risks to the expectations of the market, but also the tail risk, the probability of recession. So the fact that we're simply in a range and moving to slightly higher rates is reflective of the fact that the Fed has gotten data which has been moving slowly toward their comfort zone, but not in their comfort zone. And that is simply a reflection that the market in and of itself might project a soft landing that may not necessarily come as quickly as the Federal Reserve might like.
We'll talk more about that landing in a second, but it's important to think through the expectations for corporations, the read-through in the economy. Maureen, you work with so many issuers. How much risk is under the surface for them?
Yeah, I think, much like in the investor community, the question is, when do we see peak rates and when do we start to crest on the other side? And I think that's the question that a lot of treasurer and CFO level folks are trying to get their arms around right now. Is now the right time to be, levering up your balance sheet, refinancing debt, funding acquisitions, digging into CapEx at these, elevated rate levels? Or is this the rate environment we're going to be in for some time? And I think you're starting to see around the edges a little bit of acquiescing where companies are willing to extend duration a little bit across the curve, willing to lean in a little bit, recognizing that this higher for longer narrative is probably with us for some time. And, a 2.5% 10-year Treasury yield is probably something of the past.
It's interesting to see the mid-year expectations for rate cuts next year still. Do you think the corporate issuers, Maureen, are having different expectations about rates lowering at all from here?
Yeah, well, I think you definitely saw it last year, right? Last year we were in the middle of a rate shock, and the narrative was this is transitory, this won't last, we will be looking at materially lower rates at some point in the near term. And you saw the duration of issuance get much shorter on the curve. You saw borrowers accessing the CP market in larger size. You saw borrowers accessing floating rate debt, bank level debt in larger size in an effort just to kind of bridge themselves to a lower funding environment in the future. And now you're starting to see that narrative shift shift a little bit. So while the market is definitely pricing in cuts for next year, roundabouts 100 basis points or so, I think the overarching thesis that we're starting to get our sense of with our corporate clients is that that might not actually play out. I think there'll be some normalization in the curve, but I think in terms of term level interest rates, while we might see a little bit of relief, I don't think anybody is forecasting a materially lower rate environment over the course of the next 12 months.
Now, how do these expectations change when you see the economic data come in, Jerome? Do you think that this supports the case for even higher for longer when the Fed is thinking about their calculus?
Yeah, I mean, for one, I think that we have to be, focused on that the Fed is probably not data dependent in the immediate sense as you might think. That will probably be articulated sense in terms of a hawkish pause, suggesting that they're going to remain vigilant but not necessarily act. We do expect that there's a possibility of additional rate hike at PIMCO later this year, but I think we are getting to that top end of the crescendo of the rate hiking policy sequence, which means that ultimately, we have to get comfortable with the higher rates for longer. Now, the second part of that sequence is how quickly inflation comes back down to the landing zone that the Fed wants of that 2% rate. And while we do think that core inflation, especially the more favored metrics that Jerome Powell likes, ex shelter, et cetera, we don't necessarily see that happening as quickly. So one of the reasons that we anticipate what we would call a softish landing at PIMCO is the fact that inflation figures will probably remain stickier than central banks would like for the immediate sense, which means some of that 100 basis point rate cut that's forecasted for next year might not actually come to fruition over the course of 2024 and 2025. So that friction, that reconciliation is something that investors can actually benefit from by being at the front end of the yield curve, but at the same time recognize that yields are very much more attractive across the curve compared to where we were 6-12 months ago, given the recalibration of rates.
We know that things would come fast and heavy after the Labor Day holiday, but next week is pretty much a doozy. You have the Fed, you have the BOJ. When you think about the relative story of the United States, Jerome, how complicated does that make your job?
Yeah, it makes it complicated because not only are we weighing geopolitical factors, economic data factors, we're weighing other factors from central banks. In fact, obviously this week we are not only considering the hawkish pause to come from the Fed, but the dovish hike that happened at the ECB. Bank of Japan clearly is in play, and we're dealing with various factors of globalization and effectively deflation, which might have longer-term effects within the economic sequencing. What I think is important is to recognize the fact that there will be need for a little bit of higher degrees of flexibility, not only within portfolios that we manage, but also from issuers' perspective, from investors' perspective, to understand that the transition period might not necessarily be as smooth as people would expect, and there could in fact be aftershocks to liquidity, to market conditions, to pricing of credit that happen as we digest this economic cycle that perhaps isn't necessarily as soft landing as people might expect over that period of time. So these are a myriad of factors, in addition to other factors later in 2024, the election, et cetera, which come into play that might weigh on markets.
There is this idea of front running not only economic data, but to your point, key events, the elections, the Fed decision. At what point here does the actual data itself become a bigger concern? Maureen, how much are you concerned about liquidity in particular?
Well, in the credit markets, the markets have almost never felt as liquid as they do right now, right? It's certainly we are at a high point in terms of just the appetite for primary product. You'll see, dips in liquidity, certainly over the summer months and the end of August in particular. You'll see dips in liquidity as we close out the year. But in terms of the available cash and the technical landscape in both the high grade and high yield markets, it's basically never felt better. We've had a robust primary pipeline the last couple of weeks in both markets, but it's going to taper off as we move into the end of the year. So I don't expect that narrative to really change. The election, while, it's obviously on our radar screens, it's not getting much airplay in my market. It's so far off, it might as well be a decade off at this point. So I'm sure as we get closer, we're going to start to see a little bit of noise around that. But to your point around how issuers position around that, a lot of companies just want to get in front of it, right? De-risk it. And you saw that this month. There was key inflation data this week. There's obviously a pretty critical Fed meeting next week. So the month was very front loaded. We had a really big last couple of weeks, and we'll have a quiet couple of weeks to end the month as we navigate through some of those releases.
It's amazing how much nervousness has really ticked up in conversations. Jerome, when you think about the idea of data becoming much harder than expected, this idea that the soft landing might not come as soft as you would think, in that scenario, where do you go?
Yeah, what we think about is being a little bit more defensive. And while we reflect that there is liquid markets at this point in time, as Maureen suggests, we also paint a more cautionary tone that some of this liquidity could evaporate as you get tighter liquidity conditions, as excess reserves are removed from the system, et cetera. So we are on a path where we have to be very focused on liquidity. And more importantly, this has probably been never a better time in more than a decade to actually have high amounts of liquidity for defensive purposes from a corporate perspective, and not really worry about the impact to performance, meaning the drag from higher cash balances, the drag from additional liquidity isn't as consequential. In fact, it's quite beneficial at this point in time. So if you're a corporate CFO, if you're a treasurer, you're going to think about the defensive mechanism of having higher cash balances and a liquidity profile which favors higher cash balances, not just today, but over the course of the next 1 to 2 years. We're seeing that also on the investor side, where cash management has become a real focus. But I think the focal point here is that given the uncertainty of if it's a soft landing or otherwise, the tail risks are something that's relatively undervalued, meaning there is prudency to be had in being more defensive at this point in time, given the optimistic outlook that generally the market is possessing right now.
Our thanks to PIMCO's Jerome Schneider and Maureen O'Connor of Wells Fargo. Up next, we have the auction block, because that high yield issuance has seen the busiest week in the U.S. since 2021. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where the September surge is carrying on. We're going to start with investment-grade companies like Bank of America, Intuit, Nissan. They have all flocked to sell debt ahead of the week's inflation data and ahead of the Fed next week. More than $34 billion was sold. The action was just as heavy in high yield, where we had 15 sales of new supply for almost $10 billion, the busiest week since November of 2021. And an update on one of the most hotly anticipated deals in leveraged finance this year. A group of banks led by Goldman and JP Morgan have launched a $4.4 billion debt sale to fund the purchase of a majority stake in payment processor WorldPay. And when it comes to credit, BNP's Megan Robson is focused on spreads.
We do see downside for credit spreads. We're forecasting wider spreads into year end. To really break out of this more narrow range, though, we do think we need to see more material weakness in the consumer.
Joining us now is Axonic Capital's Peter Cecchini and Mike Contopoulos of Richard Bernstein Advisors. Mike, before the show, I told you to come on and be my spreads guy because they are so sanguine. I need to know where you think things are going to start to crack as things do stay higher for longer.
Yeah, they are very sanguine. I mean, you look at investment-grade corporate bond spreads right now, and they're only about 119 basis points. So the investment-grade market is effectively pricing in the best of times. And that, I mean, listen, at the end of the day, the risks behind the investment-grade market are not huge, right? I mean, most investment-grade companies have termed out their debt. Many of these companies generate a ton of cash flow. They're high-quality companies, of course. The problem is the spread already reflects that, and you can pick up similar yield without taking the credit risk. So from our perspective at RBA, it's not that, we expect spreads to widen dramatically to 160, 170, 180 basis points. It's more a function of you can create structures that, where you take no credit risk and get a similar type yield. So why not do that? The other thing that's concerning to us is if you look at the VIX, if you look at MOVE, they tend to be very good leading indicators of where spreads are going. And MOVE and VIX are very, very low at the moment. So what happens if those accelerate for any reason? I mean, you're coming off a bottom. It's easy to see that happen, and spreads should widen if that were to happen. And again, you just don't have much upside here, and that's what we're concerned with.
What about the riskier stuff? You're even talking about this in the safer parts of the market. Peter, when you think about the high yield sector, do you have some concerns about where things trade today?
Yeah, no, I think that was very well said. I think this is about risk-adjusted return and asymmetry of returns. And you're really not getting it in either IG or in high yield for that matter. When you're talking about high yield spreads just above 400, 430, let's call them right now, that doesn't square with our outlook, at least of what we're seeing on a forward basis with the economy. Certainly, the VIX in particular has been almost useless, given that its composition is affected by 7 or 8 technology names that have done nothing but rally on an AI narrative. Rates fall has actually remained fairly well bid, and it actually tends to be a little bit of a better indicator on a forward basis. And then, of course, there's yield curve volatility, and we've had a yield curve that has been inverted and inverted very deeply for some time. And I think that is speaking to the forward outlook a little bit better than, for example, the VIX might, given the composition issues with the S&P 500. So we don't think risk-adjusted returns are very good in high yield or IG right now. So I agree. We can find better returns, frankly, in structured credit, where we tend to play a little bit more near the top of the cap stack. We can get high single-digit yields for almost no credit risk in that market. And so we are focused there for the most part right now.
You know, I want to read this quote to you from Apollo's Torsten Stock, writing in a note this week that balance sheets with higher debt, lower earnings, and lower savings will get first hit by Fed hikes, both for consumers and firms. And as the process continues, Fed hikes will gradually impact higher quality balance sheets over time. Now, there are still questions even about that consumer part of this story, and even some of these lower quality balance sheets, as you guys have been talking about. Mike, where is the canary in the coal mine here that perhaps the market is not yet factoring in where the risk could be?
I mean, Torsten's absolutely right? Your weakest companies go first, weakest companies lead, the stronger companies, small leads large, and you're already seeing defaults accelerate in a large part of the market. They just tend not to be the large index names. But if you look at actually defaults in the United States of America through August, you've had more defaults through August than any time since 2010, immediately following the global financial crisis. And much of that risk resides in private credit and leveraged loans, the floating rate portion of the market. Many of these deals were underwritten in a time where LIBOR SOFR was 0, and the yields, the coupons that they were paying were in the 4 or 5% range. The other thing that was going on back in 2020 and 2021 and the first part of 2022 was you were underwriting this debt with incredibly rosy outlooks on where EBITDA growth was going to be, and all the power was in the borrower's hands, so covenants are quite poor. That's a recipe for disaster when earnings growth slows and defaults start to accelerate and rates go up a lot. And so, I think that's the canary in the coal mine. It's in the private credit space, vintage deals from 2020, 21, leverage loans, floating rate debt. To me, that's what you need to be paying attention to, and you're already seeing it.
Now, I also want to point out another comment from this week from Bridgewater's founder, Ray Dalio, speaking at the Milken Institute Asia Summit earlier this week. He said, I don't want to own debt, bonds and those kinds of things. Temporarily right now, cash is, I think, good. Peter, where does cash stand in the equation right now?
Well, I think Michael articulated it well, and I think, of course, how can you disagree with Ray? Although you can, it's a tough one. I think cash is a reasonable asset class at the moment. And when we talk about cash substitutes like T-bills or even out, to 2-year treasuries, when we can get above 5%, when I compare that to equity yield or equity dividend yield or most other things, again, risk-adjusted return from a risk-adjusted return standpoint, it's attractive given our outlook. There's a lot of fragility here, and in particular, there's wild dispersion. And I think Michael said it well. We feel the same way about the levered loan market. There's a lot of leverage there. EBITDA is trending weaker. And by the way, that dispersion also applies to the U.S. consumer. I mean, a lot has been made of how strong the consumer has been. And, much of that is because of the fiscal stimulus and an unprecedented amount in form. But we're seeing for subprime borrowers, for example, quite a bit of dispersion and weakness. So for lower FICO borrowers, when we look at remit data, for example, we're seeing delinquencies tick up at quite a rapid pace.
You know, it's crazy. It's been, when we think about leverage, about 15 years since the Lehman collapse and 25 years next week till LTCM. Yet leverage comfort at higher rates is still at an all-time high. It's our thanks to Axonic's Peter Cecchini and Mike Contopoulos of Richard Bernstein Advisors for drawing out all the risks underneath the surface. Now, still ahead, the final spread. The week ahead, a busy week for central banks and investors with the Fed decision ahead, and a look at markets as the S&P now hits a session low. This is Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread the week ahead. Coming up, we have the UN General Assembly starting Monday, and Ukraine President Volodymyr Zelensky is expected to meet with President Biden at the White House during the week. And on Tuesday, we get Eurozone CPI data. Wednesday is that big Fed rate decision, followed by the BOE decision on Thursday, followed by initial jobless claims in the United States and U.S. existing home sales. Friday, we are looking at a BOJ rate decision. Now, taking a closer look at the Fed decision, we can take a look at the WIRP function on the Bloomberg terminal, because as the markets await the Fed's decision, there's mostly an expectation for a hold. Markets are pricing in a more than 30% chance of a rate hike in November and are still expecting cuts by the middle of next year. And that makes that dot plot ever so important. With inflation still above the 2% target, the question of how much the data supports a hawkish hold, this idea has the potential to take speed. Now, I do want to get a quick check of the markets, because we are watching now at a session hold at low. We have the 2-year yield at 5.02. This has been on a tear all week off the highs, but we have a 10-year yield also about 2 basis points moving higher, about 4.31. We are looking at the S&P at a session low at about 1.1% lower on the day. That is after a ton of green on the screen throughout the week. But, you know, that does it from New York, from us. More markets up next. This show, same time, same place next week. Bloomberg's Real Yield is over now, and this is Bloomberg.